Hi guys, my name is Raghav. I'm the founder of AlgoTest, and today I want to show you a very exciting product that we worked on. It is a volatility analytic tool that we have prepared for the Indian market. This is the first time in the Indian market something like this has been available. The tool is called the Volatility Risk Premium Dashboard, or the VRP Dashboard for short, and it essentially shows you how the market is pricing risk using options, right? Now, what do I mean by that? So first of all, guys, a brief intro about what VRP actually means. So the VRP is essentially the difference between the implied volatility of a particular option and the realized volatility of the underlying or the life of that particular option. Okay, so it's the difference between IV and RV. So one interpretation of implied volatility is what the market essentially thinks how volatile the underlying instrument is going to be over the life of the option. So let's actually take a look here, right? So if I go to AlgoTest and Nifty. Okay, so now guys, you guys can see my screen over here. Essentially, when I say that, the implied volatility of the 28-day expiry Nifty option, at the money option is 16.1%. What this means is that this is the market's best prediction, the market's best estimate of how volatile Nifty is going to be over the next 28 days. Okay, that is what implied volatility means. That is one accepted interpretation of implied volatility or IV, right? So it's very simple, guys. So think of the IV as a prediction. So it's the market's prediction of how volatile the market thinks the underlying is going to be over the next few days, right? The next few days, which is the life of the option. Now, if the IV is the prediction, the realized volatility is the actual value, right, of that prediction. So very simple example, guys. If I'm predicting today that, hey, Nifty will open up 500 points tomorrow. Tomorrow, I'll be able to check if my prediction was right or wrong, right? It's the same with implied volatility, that after the option expires, I can actually check what the realized volatility was and if the prediction was right or wrong, right? So this realized volatility is essentially the fluctuation of the market over the life of the option, right? Or the fluctuation in the underlying instrument over the life of the option, and that is what the realized volatility is. So essentially the difference between the market's prediction and what the actual value was is called the VRP, or the Volatility Risk Premium. So VRP is essentially IV minus RV, right? So now that we understand what the VRP is, let's take a look at this dashboard and get a little bit better idea of how we can actually quantify this and use this in our trading. Alright guys, so let's get started. So we'll start with implied vol settings first, right? We'll start with this section over here. So over here, what you see is this little label which says constant maturity. Now, what does constant maturity mean? Constant maturity, let me actually illustrate the need for using constant maturity with this particular example. So here, guys, I've used the simulator to go back to 24th April 2025, which is expiry for Nifty, and I've taken this trade at around 2 p.m. Okay, so what I've done is I've essentially bought two calls, one the 24-250 call, which is expiring in a few minutes, and I bought the 24-300 call, which is going to expire in 14 days. So notice their IVs, guys. So this has an IV of 4.6 and this has an IV of 14.8, right? As I move ahead in time, what you'll see is this IV has only moved by 0.3 points, right? But this one has moved by a few points. It's gone from 4 to 7. Let's move it again. Now it's gone from again 7 to 5, but this hasn't moved. This has barely moved, right? Look at this guy now. It's at a 1.8 right now, right? So what am I trying to illustrate here? What I'm trying to illustrate here is, guys, that the difference between these two options is they're both at the money, or they both started at the money, but the difference is that the time to expiry is very different between the two, right? One is 0 DT and the other one is expiring in 2 weeks. Now, when the time to expiry is different, then you see that the IVs are also behaving very differently. So if I want to compare the IV of Nifty across time, right, then I can't be comparing the IV of two options which are expiring at different periods, which is why what we do is we normalize the implied volatilities to have the same time to expiry. And that normalized implied volatility is what we call constant maturity. So here we've taken 3 standard constant maturity dates essentially. I'll use 30-day over here and let it load. So let's remove RV from here for now. So every data point here represents the 30-day implied volatility for Nifty. So this is essentially the 30-day Nifty IV. Okay. Every data point here is essentially saying that, okay, this was the market's prediction of how volatile Nifty would be over the next 30 days. right? That is the interpretation of IV. So I hope you guys understood this concept of constant maturity, guys. If you didn't, please let me know. The only reason we are using constant maturity IV is so as not to compare apples and oranges, so as not to compare a 1 DTE IV with a 30 DTE IV, because we know these IVs behave very differently, right? If you still have questions, please post them in the comments below, and of course I'll answer. Now let's move to realized vol settings, right? So what's happening over here? Now, realized volatility is essentially how much Nifty fluctuated actually, right? If the implied volatility is how much the market thinks Nifty will fluctuate over the next 30 days, realized volatility actually tells us how much did Nifty actually fluctuate over the next 30 days, right? So we'll use some very standard techniques over here. Here, what we are going to do is we are going to use a 30-day look back period. So that just means that, we'll look at the previous 30 calendar days and we'll use the Nifty's movement over those 30 calendar days to calculate the realized volatility. So you can see over here, it says using 30-day realized vol sample daily. We will be using, instead of standard RV, we'll use integrated RV, which essentially removes the effect of drift. So if there are trend effects. So if you have questions about this, guys, if you guys don't understand this concept, or if you guys want to learn more about this concept, we actually have a community and a course on this particular topic itself, which is, volatility trading. So anyway, we'll use the 30-day look back period, and we'll use the 30-day implied vol constant maturity. And here, what I'm seeing is every data point here, right? So let's actually zoom in on what's happening in recent times since the Trump tariff game has started. So what you can see here, guys, is before the Trump tariff game, both IV and RV were kind of close to each other, but IV was slightly higher than RV. Let me actually explain to you what this data point means right now, right? So let's look at this one particular data point, which is 30th April 2025. So over here, what we are seeing is that IV is 16.18%, but the realized vol is 21.26%. Okay. Now, IV, of course, is, guys, forward looking, right? So IV is forward looking, and by forward looking, what I mean is the IV on 30th April 2025 is 16.18%. Then the market is saying that, hey, over the next 30 days, the realized volatility is going to be 16.18%. That is the market's estimate, right? And realized volatility is backward looking. So realized volatility on 30th April 2025 is telling us that, hey, over the last 30 days, the market has moved by 21.26%. So we have this little tool called lag RV by 30 days. So when I do this, right, now what happens is, now I've essentially aligned my prediction, which was IV, to the actual value, which was the realized volatility, right? So what you can see here is in the last few months or in the last few weeks, if you were buying options, you would have made money, right? So this data point here essentially shows that, okay, the IV on 1st April was 12.82%. Okay, back a month ago, the IV was 12.82%, but the realized volatility over the next 1 month was 20.25%, right? So this essentially is telling us that it was a great period for option buyers and not so much for option sellers. One way you can actually use this tool is a very standard way of using this particular tool, which is, if I have to forecast realized volatility, the best estimate for that tomorrow is what the realized volatility is today. I can essentially say that the behavior of volatility is, this is a known sort of effect that, volatility clusters in the short term and it mean reverts in the long term. So when I say the volatility clusters in the short term, what I mean is that in this case, if the realized volatility is around 21.26%, then the expectation is that it will stay around 21.26%, at least in the short term, for the next few days, right? So you could technically say that, the best forecast that I can get for realized volatility is going to be 21.26%. So let me just buy an option over here. That is one way in which you can use this particular signal, because IV is less than RV, right? Of course, a forecast like any other forecast could be wrong. In general, what we see historically is that, implied volatility tends to be priced higher than what the subsequent realized volatility is, which is what we call the volatility risk premium, right? Another thing we have, guys, is you have the ability to select different realized volatility estimators over here. This is feedback that we received from somebody when we rolled out this particular product, that they would like to see other realized volatility estimators as well. By the way, guys, realized volatility is not something you calculate. We say we estimate it, okay? Because we are always trying to approximate what the true realized volatility of the underlying is going to be, right? Or whatever the true instantaneous realized volatility of the underlying was. So One particular cool thing that I can show you guys is, let's look at it over here, right? Let's go to the strategy builder. This is one cool side effect of this particular tool, which is that if your option is expiring in 21 days, for example, right? So the 21-day implied volatility is 16.2%, as you can see in the strategy builder over here. What I can do is I have the ability to essentially, let's select 16, what was it? How many days to expiry? 21 days. So I can essentially go over here and I can select a 21-day look back period. And now what I can see is that this is the 21-day realized volatility. So interestingly, guys, this allows me to essentially match my days to expiry with this guy, right? So if my days to expiry here was 21 days and I wanted the 21-day realized volatility, that hey, what was the realized volatility over the last 21 days? Then I can essentially get that data from here, right? And I can put any number over here. If I'm trading like a 5-day option, so here let's say when is the weekly option expiring? Weekly option is expiring in 7 days. So here I can essentially trim my look back period to 7 days, and then this will tell me, hey, what is the realized volatility over the last 7 days, right? And what you'll see here is that there's been a dip in the realized volatility over the last 7 days. RV has come down significantly. In contrast, if I were to use a 30-day look back period, I would see that, hey, RV is actually higher, right? So what this tells us is the last 2-3 days have not been so volatile, but the last 30 days have been quite volatile in totality. Let me also explain to you this particular table, right? So what this table does, let's add some more data here. So what this table does is it essentially breaks the range of IV over the last. So the earliest date I've selected here is 18th June 2024. So in the last 10 months or so, what we are seeing over here is that implied volatility has had a different range. It's gone from 10.68 all the way to 21.79. So all I've done is I've split this data into, equal sort of buckets. So here it says each row contains approximately 21 items. So each of these buckets has 21 days in it, right? So there were 21 days when IV was between this range. There were 21 days when IV was in this range. And what you can see here is that the average IV during those 21 days was this number, and the average RV during those 21 days was this number. So as you can see, it has not been a very good period for positional option sellers, because the VRP, which is the difference between IV and RV, is actually lower than 0 for most of these observations, right? Let me actually get rid of the election period here. Once I get rid of the election volatility, then this becomes something that you expect a little bit more, that hey, the VRP tends to be greater than 0. Of course, the election time volatility was not something that was predicted, right? Everybody thought that Modi ji will win. It was 400 par. That's what the exit polls also said. But when the vote counting actually started, it seemed for a moment that Congress would also win, right? Or the Congress alliance, whatever that is, they would also win. So as a result, the market started tanking, and that's where you see this increase in realized volatility, right? So this is the feature, guys. You also have the ability to, sample on a weekly basis instead of sampling on a daily basis, which is pretty cool. You see a little bit of seasonality in Nifty over here. Yeah, so I hope, guys, this was a useful video for you. I hope you guys find this tool useful. I use it almost every day to see how the market is pricing risk. And yeah, I hope you guys find it useful, guys. Please share your feedback with me, and would love to hear more from you. If you like this content, guys, please like, subscribe, comment, interact with me, join us in our Telegram group, give us money, whatever. Thanks, guys.